Morning to you. Today is Wednesday, the 26th of August, 2026. We're getting closer to month end on this amazing Q3 of the year 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory board. As a reminder, this week theme is looking at what changes when you, as a founder, stop being the hidden full operating or operator of your company. You're hidden operating your company, you like it or not. This is not an accusation or a reprimand or anything like that. It's just an observation because this is happening and you incorporate that as part of your job. And you started your company many years ago, and today you say, well, this is part of my job because it's normalizing what the small changes are happening every day. And here's the point: an advisory board can be your operating system that moves the business beyond depending on you, right? This is a theme of this week, and how to employ an advisory board to help you to detach yourself from the business and start to work on the business again rather than in the business as a full operator. And these operating functions sometimes are hidden, as I mentioned, and you don't realize how much it is. And we are going to cover one of them today, which is the partnerships, revenues, and assets, particularly in the capital predictability and growth and capital of your business. This is a stage where it catches uh, good businesses, not failing businesses, right? So the growing ones, the businesses are thriving. So clear clients are buying, the teams are busy, revenues rising, the numbers look larger, right? But you have challenges that probably are not aware of. And let's focus on this section of the model, which is a growth and capital. Let's dig in today. So probably you as a founder don't feel richer or calmer or in control. And that's part of what you feel is your obligation. Is all this is a part of the job. And you may speak with many of your colleagues or peers, and they are in similar situation. So what happens? And these are a few things that people tell me that is happening. The cash feels tight. The margins are softer than expected, right? I mean, in terms of profits, working capital feels heavy. So working capital seems a constant battle. Pricing moves around depending on who is negotiating in your team. The company carries projects, offer and clients that seem important, but nobody's quite sure what they contribute to the organization, right? So yeah, you have these, and we have this project for this, a project for that, a project for the other. But what is exactly the contribution to the overall bottom line of the company? And that it feels like a money trap, really, because the top line tells you one story, but the bank balance and the management pressure tell you another story. Now, let's take a look at three problems with this. Problem number one is the revenue hidden or hiding weak economics. And here's the things that you are going to observe. Not all revenue is equal. Some revenue creates a good margin, some create repeat business, right? So if you have to identify which one is which. Some brings strategic customers, which is new logos or good logos, and some revenue keeps people busy while creating very little cash, right? So it's this customer that has, for example, a good volume of business, etc., but in time negotiated a price or a discount or a facility that actually is today is not really producing the benefits that you expect that should produce at this stage. And other customers look impressive. I mean, the big logos, etc., but demand so much senior attention or your team's attention that the economics fall apart, right? So the team is dedicated to them almost when they should be looking into new business or taking care of businesses or customers that produce a better margin. So if you only ask to your team how much did we sell, you are missing, I think, a very important questions. Questions like, what did we keep out of those sales? How quickly did we, how quickly the cash arrived? Uh, what we have to give away to win the business, right? So what was the facility? A longer payment term, a deeper discount, an extra on top of it, you name it. So what do you have to give away to win that business? How management attention did it consume? And because time is the only thing that you can get back. So your management attention should be in where's the profit margins and how to improve them, or what would be uh, perhaps this is a question that nobody asked. What we should do differently next time in a similar situation with this similar business, right? So this is when you start to improve the revenue quality, and this is a big problem that many companies have, because they only look at the book value. They don't see the quality of that revenue with this a few questions I share with you right now. The second problem is pricing being decided too close to pressure. So you decide the pricing not because you have a policy and a structure and a system to arrive to that pricing conversation. It pretty much at the moment of the close you decide the price, or you change your mind, or you do an escalation, or you put a business case to justify whatever is you need to justify, right? It doesn't mean that it's bad, good, or wrong, or correct. It means that it is too close into a moment of pressure. So when you are under pressure, usually the decision is not very good. So what happened in this moment of pressure? A sales guy needs to close, and they want to close, and they're very, very convincing why they need to close the business. I put this business case in front of you, and you say, yeah, it makes sense, but actually it doesn't feel right, but we have to close it. Or a director wants to keep an old client happy. Yeah, but back to quality of revenue, what that client is bringing to the company too, right? So, or you as a founder value that relationship, so you give in into things that you shouldn't, or a project team accept extra work because it doesn't want a conflict. And sometimes that, as silly as it sounds, a conflict gives away things, or lose, let's say, pretty much your policies, because people doesn't want a problem. But perhaps you should have that problem, because actually it's affecting the company. So each decision looks small, but altogether they create a bad habits everywhere in your organization. Discounting, scope creep, as they call it, weak payment terms and price expectations, margins slowly leak out of the business, etc., etc. And the third problem is the capital following the loudest request. And this is mostly an internal thing, right? So people want budget for their departments, their projects, their business cases, whatever is the case. One team wants a system or better system, or licensing or software, or hardware, whatever is the case. Another wants a recruit or headcount. The other wants a product needs more money to develop or improvement, or a promising client needs an extra support. So you need to bring them to places, conferences or fairs, etc., etc. New market looks attractive, so you want to send people to investigate or ask for a report about this market. So you need money to pay for the consulting firm that's going to do that report. So each person in your organization has a very reasonable argument, but without capital gains, the business funds too many half-clear projects. So then 6 months later, there are 15 live projects, all described as important and none properly finished. So in other words, imagine a ship taking, or a cargo ship vessel taking on more cargo while the crew is still debating how much weight is carried, right? So yeah, we can take more. Where the weight sits and whether the balance goes, and the route has changed, but you still bring in more cargo in every port you go, but actually your destination is different now. And so it's very difficult to the weight and balance and the destination and the cargo that you have inside. You say, why we are carrying these containers if we are not going to that port, right? So the ship is moving, right? Is reaching every port, and the port that shouldn't reach to, and taking cargo that shouldn't. But that doesn't mean the ship is balanced and going to the right destination with the right cargo or the right expenditure to deliver that cargo, because sometimes you have to step back, etc., etc. Well, so you understand which is analogy. So as a board advisor, what I would propose to consider is the following. Number one, start with a portfolio truth, right? Bring margin by offer, bring pricing rules, debtor days, working capital pressures, capital commitment, what projects are competing for the piece of budget that you have. Bring the customers that look good but create friction. And again, the point is not the finance theater. The point is to see where value is created, where it gets trapped, and where it gets destroyed. Once you have that list ready, classify your business. That's point number two. How you classify your business in three areas. Which areas of the business should keep growing, right? So they have demand, healthy margin, is repeatable, and is a strategic fit with your organization. The second area is a business, what should be fixed in your business. So perhaps demand is good, but the pricing is poor. That requires fixing. Perhaps the offer works, but the delivery is messy. That requires a fixing. Perhaps a client group is valuable, but cash collection needs attention. That needs a fix. The third thing to classify your business is what should be exiting, which is a switch or what is called the kill control or kill switch. This is where you as a founder often struggle because history gets involved here. So relationships get involved, pride gets involved, a lot of emotions get involved. But sometimes, unfortunately, and for the sake of the good health of your business, you have to say no to things that before you would allowed. But it's better to do it when you have this business classification of yourself and your capital, as I mentioned, your portfolio truth ready, because then you can rationally explain to your team and say, listen, we have to grow the business and we need a margin for grow the business this way. This is the way we want to fix it. And unfortunately, this project have to be discontinued, these customers or whatever is the case. So you have a rational, very clear, a very path of explain why you had to decline certain projects compared to other, or stop completely certain projects, right? So this is the best way to do it. Then it's much easier to say no. And the third thing that you have to consider is your capital gates, which is related to where you say no or where you say yes to certain things. So before another dollar, pound, or euro is committed to a major project, ask a few questions. What return are we expecting? Over what period? What evidence supports the case? What risk are we accepting? Who owns the outcome? What will make us to stop this? And more importantly, how it contribute to or aligned with the other projects that we are running, right? So as an overall part of the company ecosystem, not as an individual isolated project, as a test. You can run it as a test, but then you have to reduce the budget big time for that. And the question perhaps that people forget is, what else could this money do, right? So if we do this, what else this money can do? What are other things we can deploy this money that actually will be better than test something that actually is unproven with something that is already proven and can increase your margins, your profits, or the bottom line of your organization. So every yes is also a no somewhere else, right? So that is the capital allocation, the discipline that you're looking for. And here's where the advisory board gives you distance, right? So if you want another layer of arm length to make this decision, employ an advisory board. The advisory board asks whether the capital still deserves to be there, growing, fixing, or exiting certain areas of your business, and how you deploy that capital, which is the discipline, which are the gates. So the advisory board brings finance, commercial, and operating judgment together. So the finance guys can see the cash, the commercial guys see the opportunities, and the operation sees the delivery cost. An independent board can force all three views into one same page, right? And you don't have to make that decision, you have to make that decision, but the views of how that decision is structured is independent. You don't have to do it by heart anymore. So it sounds, for example, the things that you're going to be challenged with is, for example, revenue is growing, but the economics underneath are not even. So what if we review these before trying to deploy capital in a new project? Or pricing rules exist, but the pressure regulatory overrides them, right? or there are many projects that require surviving because stopping them feels harder than continuing them. But do they need it? As we mentioned already, do they need to continue surviving, or is it time to tell them it is up to this point because it doesn't contribute or is not clear the contribution towards the organization plans or vision or strategic activities. That is the value of the observation that brings an advisory board. They reduce the emotion in capital decisions, and it's very important because cash pressures change behaviors, right? So you start to feel the pressure everywhere. And particularly when cash becomes tight, the company starts making shorter decisions. The time lapse for decisions is shorter and shorter and shorter. And what happened with that? Discounts to close, delay to investment, keep poor clients, avoid stopping the project because money has already been spent. So this is where the advisory board creates the discipline before pressure makes the decisions for you, right? You don't want to be forced to a decision. You want to make a decision and have a very good reasoning behind it and very well documented, if you may, or supported in terms of why you say yes or no to these decisions. So what do you gain working with me? Three things: outcomes, differentiators, and risk reduction. In terms of outcomes, a clearer growth, a better margin logic, a stronger cash visibility, and a clearer decision about what deserves funding in your organization. In terms of differentiators, it's an international advisory board that we can put together. We match the growth and capital problem, the financing, the pricing, the operation, the commercial judgments that sits around one decision rhythm with a faster access than hiring one executive, because we can put a board of advisory in 2 weeks together, with a lower overhead than a big consulting firm, and no talent locked in because we can swap members every 6 months. So let's say that we fix this capital growth milestone in your organization and say, okay, what's next? Then we can move certain people around to make sure that it's more relevant for the next project or milestone of the organization. And how it helps you to reduce risk is the low quality growth, the emotional pricing, and the capital trapped in projects that should have been fixed or stopped. I can give you that reassurance of the things that can be and cannot be done and why, and all the supporting rationale behind it. Now, how you can do this at home today in 30 minutes or less. Let's put our little chart here in front of us, and I give you this. You can screenshot this now, or in LinkedIn, I put it later on. So this is your revenue patterns. This is where you can start to identify all the things that we mentioned today. So list your 10 biggest revenue lines, offer, products, or customer groups. Then again, each one score 4 things from 1 to 5. So which is the revenue, the gross margin, the cash friction, and the founder's attention. What attention deserves from you or not, or doesn't deserve from you or not. So then find this other pattern. Which are the things that actually are scoring lower than higher? And then you have the high, this is the bad ones, high revenues, low margins, high cash friction, and high founder attention. And if you have many of these, those are the ones that deserve your attention. Write 1 or 3 words beside it, what you should do. Grow this, fix them, or exit them. So you don't need to define the final decision today, but you can start with your advisory board or your executive team, the conversation of why these revenue lines require attention, which one you can grow, the ones you need fixing, and the ones that unfortunately have to be fixed. And you have all the reasoning here. It's a very good exercise because it detaches the emotion from it and can be very well documented afterwards. Right? So let's pause here for today and reconvene tomorrow, because tomorrow we move into systems, the operation procedures, the IT, the hardware, the software, but more importantly, how you operate your organization. That is where the successful business can still carry dangerous controls gaps, because you, as a founder, unfortunately, remain the person spotting and catching too many of the misses of the whole organization. So if you run a company with more than 50 employees or more than 100 million in revenue, and growth is not creating the cash confidence you expect, let's have a 30-minute chat so I can understand where you're coming from, where you are, where you would like to go, so we can put together an international advisory board around your business predictability milestone. Have a great day, and let's talk tomorrow. Thank you. Bye.